Hi everyone, in this video we're going to learn about the bear credit spread. In the previous video we saw what the bull credit spread is, and we saw that we're utilizing some puts. In this case we're going to use some calls, and obviously, as the name suggests, it's a bear credit spread, so that means you're rather bearish. And I say rather because it's not the most bearish strategy, because even if the stock stays flat, you can still make money. Just like the bull spread, it doesn't have to go up for you to make money. This one is just kind of the same concept, where you make money if the stock does not go up. Okay, if it doesn't go up drastically, or if volatility doesn't increase drastically, you can still make money with the bear credit spread. So let's take a look at an example, and we're going to use again Amazon as an example. Let's pull out the chart here, and you can see the price is approximately 330. Now for our example, we're going to use 335, and I already pulled out the option prices. So let's take a look at what's a reasonable level. So for example, let's say I think that the stock price will stay above or actually below 370. All right, so let's pull back the chart again. So if I think the stock won't go past 370, let's say it's about here. I'm just trying to demonstrate on the graph where it is, so you have a feel of the strategy and how you would implement the strategy. So for example, you could put a lower level, but there's more chance that it hits it before the next before your expiration date. Let's say if you're selecting 1 month away, which is about August, well, there's more chance that it hits 350, for example. It's tighter and it's a bit more risky than if you put 370. You could put a higher amount still, but you'll collect less premium. Okay, so it's always a trade-off between the premium you collect and the riskiness of the strategy. So in this case, I think around 370 is fair, is reasonable. Okay, so how would you implement the strategy? Well, you would first sell. It's always selling a call, and it would be at 370 strike price, and you would collect $5.05 for this one, and you would buy a call, same expiration date, but you would pay $4.20. Just before recording this video, I pulled out the prices. You can have the price on CBOE or any website. It's very easy to. I actually selected the midpoint between the bid and the ask, so it's kind of a realistic scenario. So this is about how much you would earn. So you would earn this minus that, so it's like 85 cents. Okay, that's how much you would generate. So let's take a look at the graph and see what it looks like. All right, so whoa, what was that? All right, so let's take a look at this graph. Let's try to make it straight. And here it's always the price of the underlying security, and here it's the profit you can expect. And it's the graph at expiration date. Remember, it's a little bit different when there's still some time before expiration. Okay, so let's say the current price is around 335. Let's say it's here, so that's where the stock is now. But what if it's at 310? Not 310 actually. This is for the bull credit spread, so let's leave some room. Let's say 335 is here, and on the upside is 370. This one, by the way, this is the strike price here, and the other one there. Boom. All right, so you would generate an income of 85 cents if the price stays below 370. And so it would go from here all the way to 370 like this, and at 375, which is about here, then you would start losing. It's not fun. All right, so it goes something like this, and then from that point on until infinity, it stays flat. Basically, you're buying this call at 375 to limit your risk, just like you were buying the put at a lower strike price on the bull credit spread. All right, so now the situation is the following. You can earn 85 cents, but what is your risk? Well, the risk for a credit spread is always the difference between the short and the long. So in this case, it's $5. So the total risk is $5. However, you got 85 cents up front, right? So it's $5 minus 85 cents. So you have a total risk, which is kind of high. It's $4.15. Now the total profit, how you would calculate the total profit is the following. It would be what you can earn, 85 cents. And remember, it's for 100 stocks, right? So it's multiplied by 100, but let's assume it's just for one stock. All right, so 85 cents divided by the total risk. Total risk means how much of your own money you can lose, right? And so it's about 20% return. Just like for the bull credit spread, you don't really expect to earn that much, okay? Unless you actually hold the position until expiration date, which is highly not recommended. Okay, so it's because it's highly risky. That's the reason why. Because anything can happen. For example, on the last day, let's say the price rises up to, I don't know, 360, and on the last day, boom, it could go up to 375 in a single day. And you can see from the graph, it's a pretty volatile stock. Look, this is a 1 year graph, and it's been up to 400, close to 400, and all the way down to 285 or so. So it's a very volatile stock. So in a few days, it could really close the distance between, let's say, the current price and your level. So that's why it's a trade-off, right? It's a trade-off between, you know, collecting a large premium or being safe. All right, so this is the trade-off you have to think about. You know, you have to do your analysis, you have to do your homework. All right, so that's the pretty much the strategy for the bear credit spread. Hope you understood, and if you have any questions, you can leave a comment, and thank you for watching.